right now, your weather app says it's, a perfectly sunny 70 degrees outside, but you step out your front door and immediately get hit by a freezing hurricane force blizzard.
Yeah, which is it's a profoundly frustrating disconnect.
You just stand there shivering, looking at your screen thinking, am I crazy? Or is this data completely ignoring the reality of what I am actually experiencing?
Right, because you are feeling the biting wind and the actual temperature, but the system is just showing you this aggregated average. It doesn't remotely match your lived experience on the ground.
And that is the exact disconnect between the economic headlines we are reading right now and the reality of your grocery receipt. I mean, it is mid-April 2026. If you listen to the macro level headline numbers, things are supposedly holding together.
On paper, sure.
But if you are actually out there, paying for gas, buying food, trying to manage a household budget, you are feeling that freezing wind. You are feeling the pinch.
You really are. The gap between the macroeconomic data and the daily reality of, well, middle and low-income households is wider right now than it has been in years.
Yeah.
And that tension is driving a massive shift in how the entire global economy functions.
So today's mission is to bridge that gap. We are taking a deep dive into the latest real-time economic data and our source material to figure out what is actually happening out there.
The real story.
Right. Like, are we, the Western world, plunging into a dreaded era of stagflation? That toxic brew of stagnant economic growth combined with high inflation driven by deglobalization and soaring energy costs? Or is this just a very painful but temporary speed bump?
It is the ultimate question dictating global markets right now. But more importantly, it's dictating how secure you feel about your savings, your purchasing power, and frankly, your job security over the next 12 to 18 months.
Okay, let's unpack this. Before we can start predicting massive global recessions, we have to look at the immediate cause of the pain you're feeling right now.
Yes.
And that pain is supply-driven inflation. So let's look at the dashboard as of April 2026. What are the gauges actually telling us?
Well, the most glaring red warning light on the dashboard is oil. Right now, Brent crude oil is sitting between 100 and 103 arts a barrel.
Wow.
And to put the severity of that into perspective, that is a 60% increase from just a year ago.
60% in 12 months. I mean, that isn't a fluctuation. That's a total shock to the system.
It's a massive shock.
Yeah.
And it's heavily driven by the ongoing geopolitical tensions in the Middle East. That disruption in the energy supply chain is pushing the U.S. Consumer Price Index, the CPI, up to 3.3%.
Right.
And if you look specifically at gasoline, we saw a staggering 21.2% jump month over month.
Just brutal.
Over in the Eurozone, inflation is climbing back up to 2.5%, largely driven by those same energy constraints. Keep in mind, this isn't because people are suddenly demanding more goods.
Yeah.
It is because the basic fundamental cost of keeping the lights on and moving things around has skyrocketed.
I always think of high oil prices as this massive, invisible tax on absolutely everything. Because oil isn't just the unleaded gas you put in your car.
Yeah,
It's the marine fuel for the cargo ships crossing the Pacific. It's the diesel for the delivery trucks bringing food to your local supermarket. It's even like the raw chemical material for the plastic packaging wrapping your food.
Yeah, it's baked into everything.
When oil spikes, it inherently costs more to manufacture a product, and it costs more to ship it. That permanently pushes up regional production costs across the board.
I'd actually take that invisible tax analogy a step further, because right now it is compounding another massive structural shift we've been tracking, which is deglobalization.
Right, the shift away from global supply chains.
Exactly. For decades, the West built these hyper-efficient, incredibly fragile global supply chains to source the absolute cheapest goods possible from overseas.
Yeah.
It was a just-in-time economy. But as geopolitical tensions have risen over the last few years, countries are abandoning just-in-time for just-in-case. They're pulling those supply chains closer to home and regionalizing their manufacturing.
Which, sounds wonderful for national security and domestic jobs, but it comes with a steep price tag for the consumer.
Inherently so. When you shift manufacturing away from the cheapest global provider back to regional hubs in the West, you permanently alter the floor for the cost of essential consumer goods.
Because you're paying Western wages now.
You are paying Western wages and you're dealing with Western regulations. The baseline cost of producing a t-shirt, a toaster, or a car part permanently goes up.
Right.
So when you combine that structural deglobalization cost with the 60% spike in oil, you get this relentless, unavoidable squeeze on households.
And we really have to acknowledge that this squeeze is deeply regressive. It hits low and middle income households disproportionately hard.
Oh, absolutely.
I mean, if you are wealthy, gas and groceries make up a tiny fraction of your monthly budget. You barely notice the difference. But if you are living paycheck to paycheck, those are your fixed, inflexible costs.
Right. You can't opt out.
Exactly. You can't just choose not to commute to your job, and you can't choose not to feed your family. So when the cost of existing goes up, how is this reduced purchasing power actually shifting consumer habits right now?
The behavioral pivot in the data is immediate, and it's dramatic. We are seeing families drastically change their daily shopping habits to cope. First, they are pulling back aggressively on durable goods.
Like appliances and cars.
Yeah, large appliances, cars, furniture, basically anything that requires financing or a large upfront cost is being delayed. Second, they are trading down at the grocery store en masse.
So swapping out name brands for cheaper store brands, buying less meat, that sort of thing.
Exactly. It essentially forces the middle class into survival mode. It does. And beyond just spending less, people are actively hoarding cash because they don't know when this pain will end. In Europe, the savings rate has recently shot up past 15%.
15%, that's huge.
That is a massive percentage of capital being pulled out of the active economy and stuffed under the mattress, so to speak, as consumers just brace for impact.
Which creates its own problem, right? When people start bracing for impact, they stop spending. When they stop spending, business revenue drops and economic growth slows down.
A classic downward spiral.
Which brings us to the word that makes every economist break out in a cold sweat stagflation. Stagnant growth, high inflation.
Yeah.
Whenever inflation spikes, people instantly panic and claim we are repeating the economic misery of the 1970s and 80s. But wait, I have to stop here because it feels like people are constantly conflating two totally different eras.
They do it all the time.
They say we are heading for 1980s-style stagflation. But wasn't the actual stagflation crisis in the 70s? The 80s wasn't the disease. Wasn't the 80s the brutal recession-inducing cure?
What's fascinating here is how often collective memory blends those two decades together. You are entirely correct. The 1970s was the actual era of structural stagflation.
Driven by the oil shocks, right?
Yes, driven by massive oil embargoes. First the OPEC embargo in 1973, then the Iranian Revolution in 1979. Those external shocks caused massive, runaway, double-digit inflation. We are talking about inflation consistently over 10%.
So if the 1970s was the actual stagflation disease, what exactly was the 1980s?
The 1980s was the incredibly painful medicine. Specifically, the Volcker remedy. Paul Volcker, the Federal Reserve chair at the time, implemented aggressive, sky-high interest rate hikes.
Just punishing rates.
Unprecedented. He deliberately put the economy into what was essentially a medically induced coma. He caused a severe recession, crushing consumer demand and skyrocketing unemployment, simply to break the psychological fever of that 1970s stagflation.
Oh, wow.
So when people panic today and say 1980s style, they are actually terrified of the central bank's medicine, not just the inflation itself.
Okay, looking at our situation today, we have supply-driven inflation, and we have an energy shock from the Middle East. On paper, it sounds eerily similar to those 1970s oil embargoes. Are we just rerunning that same miserable script?
It raises an important question. But if we look at the underlying mechanics, the answer is no. Today's economy is fundamentally different from the structural failures of the 1970s.
How so?
First, look at the sheer magnitude of the problem. Yes, headline inflation is annoying at 3.3%, but core inflation, the metric that strips out those volatile, fluctuating food and energy prices, is only around 2.6%.
So it's a far cry from the runaway 10+% we saw 50 years ago.
Exactly.
Because it's not structural yet, it's just top-heavy from the oil.
Yes, and beyond that, our modern supply chains, even with the shift toward regionalization, are far more agile. But the biggest unseen advantage we have is energy efficiency.
What do you mean?
Thanks to advancements in manufacturing and technology, it takes roughly half as much energy to produce a single dollar of GDP today as it did in the 1970s.
Oh, that makes sense. So the global economy is essentially a much more fuel-efficient vehicle now. We still feel the pain at the pump, but we can drive twice as far on the same tank.
That's a great way to visualize it. But the absolute most critical difference between then and now is the behavior of the central banks.
Right.
In the 1970s, central banks made a fatal structural error. They tolerated inflation, hoping it was just a temporary blip that would resolve itself.
They just let it ride.
And because they didn't act, inflation became entrenched in consumer psychology. Workers demanded higher wages to cover costs, businesses raised prices to cover those wages, and it created a catastrophic wage price spiral.
Right. But today, keeping interest rates high is hurting people right now. I mean, mortgage rates are high, credit card debt is punishing. Why not lower rates to give people some relief?
Because the Federal Reserve and the European Central Bank learned the lesson of the 70s the hard way. They are fiercely independent today, and they are engaging in what we call preventative tightening.
Getting ahead of it.
Exactly. They are keeping rates elevated specifically to prevent that psychological wage price spiral from ever taking root. They know that maintaining tight financial conditions now is painful, but it's vastly preferable to the reactive desperation of the 1980s Volcker era.
Where they had to crash the entire economy because the inflation cancer had already metastasized.
Yeah, nailed it.
Okay, so we're not spiraling like the 70s, and the central banks are actively managing the risk. That means something must be keeping the global economy afloat despite these massive energy shocks. But the safety net isn't distributed evenly, is it?
No, not at all.
To me, it looks less like a unified global economy and more like two very different households dealing with the same neighborhood price hikes. Like the U.S. economy seems like a homeowner who owns their house outright and has a backyard garden to feed themselves.
Uh-huh.
But the European economy looks like a month-to-month renter who has to order takeout every night. When global prices spike, the renter absorbs 100% of that shock.
The macroeconomic data absolutely backs up that divergence. We are looking at a deep structural vulnerability in the Eurozone compared to the resilience of the United States.
It's that stark.
It is. Europe is facing a demonstrably higher risk of actual stagflation. Current models suggest a 20 to 30% probability that Europe falls into that trap, which is why European economic growth is currently projected at a sluggish, agonizingly slow 0.8 to 0.9%.
Wow. Why is Europe's engine fundamentally stalling out compared to the U.S.?
Because Europe lacks the structural buffers the U.S. has. Number one, they are heavily reliant on imported energy. When global oil or natural gas spikes, Europe absorbs the full, unmitigated blow, just like your renter analogy.
Right.
Second, they are managing high levels of structural sovereign debt, which severely limits the European Central Bank's options.
Right.
They can't just stimulate their way out of this.
She don't have the cash.
Exactly.
Clay.
And third, they are facing ongoing deindustrialization. Because energy is prohibitively expensive there. Heavy manufacturing like German chemical plants or auto manufacturers are shutting down or moving operations to cheaper regions.
That permanently alters Europe's trade balance and economic output.
It does. It's a fundamental shift.
Ouch. So Europe is taking on water fast. What about the U.S.? Why is the U.S. homeowner weathering the storm so much better?
The U.S. has incredible resilience right now due to three massive structural buffers. The first is domestic energy independence. The U.S. has vast shale oil production and strategic petroleum reserves.
So they aren't entirely at the mercy of the Middle East.
Right, because they physically pull a massive amount of the energy they consume right out of their own ground.
Okay, so cheap domestic energy keeps the factories running and the lights on, but energy is only half the cost of doing business. What about the human cost and raw materials?
Good point.
If deglobalization is making everything more expensive, how are U.S. companies absorbing those labor and material costs without going bankrupt?
That brings us to the second buffer, and it's perhaps the most vital long-term productivity gains. The U.S. private sector has poured massive investments into technology, software, and artificial intelligence over the last decade.
So AI and automation are actively fighting inflation.
Yes. When the cost of labor and raw materials goes up, U.S. companies are utilizing software and automation to become radically more efficient. They can literally produce more output with fewer resources.
That's huge.
It is. That surge in productivity helps offset those rising production costs, meaning companies don't have to pass every single penny of the deglobalization tax onto the consumer just to maintain their margins.
That is a massive structural advantage. And what's the third buffer keeping the U.S. afloat?
The third is massive government fiscal stimulus. Specifically, the sources highlight things like the 2025 OBBA Act, which is injecting extraordinary amounts of capital into the economy.
Wait, before we move on, for those of us who don't follow obscure congressional acronyms, what exactly is the OBBBA Act doing? Are we talking about direct checks to citizens or something else?
No, it's not direct checks. It functions essentially as a massive package of government, infrastructure, and domestic manufacturing subsidies. The government is directly injecting capital to build regional supply chains and fund domestic tech initiatives. It is artificially propping up consumer demand and business investment. It's a major reason why institutions like Goldman Sachs are projecting U.S. GDP growth might actually hit a very healthy 2.8% this year.
Hold on a second, though. You're calling government stimulus a buffer, but isn't dumping trillions of dollars into an already inflationary environment just kicking the can down the road?
Wow.
I mean, we might be avoiding a recession today, but aren't we buying a fake resilience by guaranteeing that inflation stays sticky for the next 3 years? Is that actual resilience or just a political band-aid?
That is the exact tightrope walk the government and the Federal Reserve are currently navigating. You are absolutely right that dumping money into a supply-constrained environment is incredibly risky.
It seems counterintuitive.
It is a massive push and pull. The central bank is trying to cool demand by keeping interest rates high, while the fiscal government is essentially hitting the gas pedal with infrastructure subsidies to prevent a recession. Right now, the government spending is successfully mitigating the risk of a deep, painful recession and keeping employment high. But the unavoidable trade-off is that it ensures inflation stays sticky and elevated for longer.
So if the U.S. has all these buffer shale oil, AI productivity, and massive government spending, is a recession actually a sure thing? Or are we just experiencing a gentle cooling down?
If we look at the probability models assigned by major financial institutions, Wall Street firms like JP Morgan or data from the New York Fed, a sudden deep market crash is actually unlikely.
Really?
Yeah, they are putting the odds of a severe recession firmly below 50%, usually hovering around 35 to 40%.
So the base case is just an annoying, slow grind, but ultimately survivable.
Exactly. The base case scenario, carrying about a 60 to 70% likelihood, is a gentle economic cooling. Economists are calling it stagflation light.
Stagflation light. Catchy.
Right. Economic growth slows down to around 1.5 to 2% in the U.S., but the bottom doesn't fall out of the labor market.
And the proof that the bottom isn't falling out is in the jobs data, right? I read something in the source material about the SAM rule. Can you explain what that is and how it proves the labor market isn't collapsing?
Absolutely. The SAM rule is a highly accurate recession indicator created by economist Claudia Sam. It entirely ignores inflation and GDP. It only looks at the momentum of unemployment.
Okay.
The rule triggers a formal recession warning if the 3-month average of the national unemployment rate rises by 0.50% above its lowest point in the previous 12 months.
But why 0.50%? Is that just magic math, or is there a specific reason that 0.5% is the danger zone?
The reason that 0.50% threshold is so dangerous isn't just math. It represents a tipping point in human psychology and behavioral economics.
How so?
Once unemployment tips past that 0.5% mark, it creates a vicious feedback loop. People start seeing their neighbors and friends losing jobs, so they panic and stop spending money. Because people stop spending, businesses lose revenue. Because businesses lose revenue, they lay off even more people. The SAM rule tells us exactly when we've crossed the tipping point into that catastrophic downward spiral.
And where are we at right now?
In March 2026, the SAM rule reading was only 0.20%. We are well below that 0.50% danger threshold. Furthermore, the U.S. economy actually added 178,000 jobs that month.
Oh, wow.
You simply do not have a deep structural recession when employers are actively hiring nearly 200,000 people a month.
Here's where it gets really interesting, though. We have these models, we have the SAM rule, we have probability forecasts, but macroeconomic models only work until something violently breaks them.
Very true.
What is the trigger that could shatter those buffers and shift us from this gentle stagflation light into a total free fall?
You're talking about the black swan scenario.
Yeah.
And the International Monetary Fund has been very vocal about exactly what that looks like right now.
What is it?
The single greatest threat to the global economy is a dramatic, sudden escalation in the ongoing Middle East tensions. Specifically, if the conflict results in a physical blockade of the Strait of Hormuz.
Because that strait is the geopolitical choke point for a massive percentage of the entire world's daily oil supply.
Precisely. If that strait is closed, it isn't just a temporary price spike at the pump. It creates a permanent structural rupture in global energy supply chain.
That sounds disastrous.
The IMF warns that an energy shock of that magnitude would drag global economic growth down to a mere 2%.
And to put that in context, why is 2% global growth the nightmare scenario?
Because historically, a 2% global growth rate is the stall speed for the global economy. It is the threshold that reliably triggers a severe worldwide recession.
So it's the breaking point.
Yes. An energy shock that massive would instantly overwhelm the U.S. domestic buffers. It would completely crush the fragile European economy, and it would force central banks into an impossible no-win choice. Either aggressively raise interest rates right into the teeth of a recession to fight the oil inflation, or do nothing and let inflation run completely wild.
Okay, deep breath. That is the absolute nightmare scenario. But assuming the Strait of Hormuz stays open and we just ride out this current painful wave.
Which is the base case.
Right. So, what does this all mean for you, the person listening to this, who is just trying to plan their life and their budget for the next year? When does the pain at the checkout counter actually stop?
Synthesizing all the data across the sources, the core takeaway is this. We are in a mild, protracted squeeze, not a total systemic collapse. If the baseline economic models hold and geopolitical tensions don't escalate into that black swan blockade scenario, we actually have a timeline for relief.
That's reassuring. What's the timeline?
Based on energy projections from the U.S. Energy Information Administration, oil is expected to peak around $115 a barrel in the second or third quarter of this year.
So, expect a very tough, expensive summer for gas prices and travel.
Yes, the summer will be difficult. But if the regional conflict eases as projected, their models show oil falling back below $80 a barrel by the end of 2026.
That would be a huge relief.
It would. If that happens, that invisible tax on everything finally lifts. Regional production costs will drop, freight transportation costs will drop, and consumer pricing at the grocery store will finally stabilize.
Will interest rates come down too?
The central banks will likely hold interest rates high throughout the entire year just to make sure the inflationary fire is completely starved of oxygen. But the aggressive bleeding of your purchasing power should slow down significantly by winter.
Which leaves us with one final fascinating thing to think about. We've spent this entire deep dive talking about how incredibly vulnerable our entire way of life, our savings, our groceries, our jobs is to the price of fossil fuels pulled out of a highly volatile region on the other side of the planet.
It's a huge vulnerability.
If we connect this to the bigger picture, it leaves us with a truly provocative question. Since relying on global fossil fuels constantly exposes Western markets to these massive inflation-inducing external shocks, will the sheer economic pain of today's oil prices be the ultimate catalyst that forces a hyper-accelerated transition to green energy?
That's a fascinating way to look at it.
Right. If energy independence is the only mathematical way to shield your domestic economy from imported inflation, then transitioning to solar panels, wind turbines, and nuclear power is no longer just a green environmental initiative. It becomes critical national economic armor.
We may end up greening the grid not to save the planet, but simply for national economic survival.
Something to mull over the next time you're standing in the freezing wind, glaring at the rapidly climbing numbers on the gas pump. Thank you all for joining us on this deep dive. Keep questioning the headlines, keep looking for the why behind the what, and we'll catch you next time.